This conference will now be recorded.
Can anybody hear me?
Yep.
Yeah. Yeah, thanks for joining. Yeah, thanks everyone for joining the call today. Yeah, this is I'm Jason Kraus, the founder of Prepare for VC, which is a startup consulting firm that basically helps companies go through the fundraising process. I'm part of this new Found Something group that Roger created as under the my co-founder brand, and basically it's a group of entrepreneurs that have all come together, and there's different mentors that basically are teaching different topics each week, and helping startups go from the beginning of their launch of their company throughout the whole process, and getting them ready to scale. So in this session, I wanted to dive into what it really takes to build a pitch deck, what investors are looking for, and how you can sort of pinpoint the key aspects in your presentation as you go through and build these, on whether it's a fundraising round or startup competition you're doing. And really, a lot of it comes down to basically, being able to present what you're doing and why you're different than the competition, why this is an exciting opportunity in a really short period of time. As most investors, whether they're venture capital investors or angel groups, they're receiving, upwards of 50 presentations a month, and to really stand out from the crowd, you have to put something together that excites them in a 3 to 5 minute window that they go through and review. And just going to take you through some of the highlights of what investors are looking for and how you can build this around your own company as you tell your story. To start off, you need to identify a problem that your company is solving that exists in the marketplace. So it's usually a key pain point you're solving, or which can be, anything from with my own company, it's that 42% of startups fail due to the lack of a market need. So, and my focus within that is helping prevent startups failing due to a lack of funding and running out of cash, and just taking some of these, basically, every this sort of the problem is, used at the beginning of the deck to sort of answer that why this is important. Why should somebody even listen to a presentation about the topic you're covering? And what are you really going out and solving that can't be or doesn't exist in any of the competition out there? So, like, for example, some of the problems I'm solving when I help through or work with startups and, go through this process of building out a pitch deck is there's, some key aspects that a lot of companies are missing, or either they go in, they have too much information and all the slides are text, and it really just overwhelms anyone that's looking at their deck, and, it doesn't really focus in on the key points and tell their story. Sometimes it's the opposite side. There's not enough info. You can, as a founder in the company, sometimes you feel like everybody else knows, knows what you're doing as well. Like, you might think some of the key, basically, like if you have, you might think one of the key features is self-explanatory to everyone else, that is really novel and makes is the main message of your business that you need to get out there. So it's just being able to present every aspect that is important and leave out some of the extraneous details. you also need to know your competition. A lot of companies will say they're the only real competitor in the space, but everything that's competition, even if it's using even if you're competing with using a pen and paper filing system versus Dropbox or another competitor, you're competing with an older way of doing things, or you're competing with existing technologies and platforms out there. Valuation, work with a lot of companies around this that want to give themselves a 10 million valuation because that's how much equity they want to give up, versus having a real clear depiction of this is companies at our stage typically sell for a certain multiple of revenue, or value users at this amount, or just base it off of the technology and expertise on their team that they bring to the table. So having a clear understanding of the value of your business really helps going through and negotiations and being prepared for investment discussions. And also, not keeping the traction up to date is something that can really hinder a lot of startups. Basically, yeah, I've talked with or worked with some companies that as they're going, they go from 100 users to over 1,000 on their platform, and forget to update their deck as they continue to reach out to investors. And there's a lot of investors that have sort of milestones in mind of when they start getting interested, and making sure that whether it's a partnership, number of users, basically anything that sort of shows traction and continued growth of the company gets updated and recorded to investors is key to stay on top of. So all of these decks should be sort of a living, breathing document, whether it's a business plan, a pitch deck, or financial projections. It should be updated and revised as the company grows and moves forward. Different companies are a better fit for different types of funding, depending on their stage and the industry that they're involved in. Can be anything from angel investments, which are usually individual investors. Also, sometimes they're part of groups that come together and review deals together and make basically pick and choose which deals they want to go into. Those are typically the earliest stage of come in anywhere from the seed stage to could be a little later, like Series A round as well. VCs are institutional investors that have funds together, or funds they manage on behalf of other people, whereas the angels are investing their own dollars into the startup. Sometimes they pick an area, like one area of expertise from previous businesses, or just that they followed and become an expert in. And other times they'll spread the risk across whatever opportunity comes their way. So then there's also crowdfunding. Started in the rewards and donation spaces with sites like Kickstarter, GoFundMe, and Indiegogo, and over the last few years, there's been the securities crowdfunding has taken off too, with sites like WeFunder, Net Capital, Seed Invest that allow both more general, basically general solicitation and advertising for registered companies on one of these platforms, to accredited investors, as well as some platforms that allow you to raise from unaccredited investors and basically gives a chance for your if it's a consumer facing company, for your customers to invest, become an equity owner in the company, as well as just open it up for larger investments from the community. Some blockchain companies are going through token sales. For that, it's key to make sure you, or at least in the U.S., to follow. Make sure you register as a security. Follow the securities laws, as some of them, or the SEC has come after some of the earlier ones that didn't really apply to the regulations there. But it's a great avenue to for all blockchain companies to be able to raise funding around either new cryptocurrencies or just blockchain platforms that that are emerging and are going to be a new avenue to tokenize, either tokenize securities, make your own currency, or just build a platform on top of this technology. For science-based or healthcare companies, those federal grants, great avenue. Secure as much of them as you can get, as these tend to be non-dilutive funding. So that means they're not taking, it's pure giveaways. You have to go through an application process, but usually it's funding that comes from the government or non-governmental institutions, where they basically give you capital to fund a mission that they have, and doesn't take equity away from the company, the founder, or the investors. So investors, angels, VCs, other investors love to see that you've secured grants. If you come in and have $3 million in grant funding, and that just adds that much value on top of what you've already built in the technology and company you put together. There's other loans and types of credit coming from the Small Business Association, or banks and alternative financing. That, depending on the industry, can be a good fit for a startup as well. So what we do, our solution is, we really sit down with all the startups that come in, go through the strategy of figuring out where the best opportunity for these companies to raise capital is, whether they're at a milestone where it makes sense to fundraise now, or whether we can help them, get to maybe they need to, or they'd be in a better position if they do a prototype, and we can set them up with either someone from Rogers Group, someone from our own group, and basically get them to a place where they are ready to go out and raise capital. From there, we do a full-scale business plan with content and design, create a pitch deck that showcases their business and the key aspects that separate them from every other pitch an investor is going to receive. We give them a one-page executive summary and help them apply to these angel groups, VCs, or get onto a crowdfunding platform that makes sense for them, so that they can go get funded and get back to what they really, basically their mission and what they want to do in moving their startup forward. And then the team is really important, especially in the early stage. A lot of pre-seed to seed funding comes based on the belief in the team, because any company is going to have competition along the way. What an investor is really betting on is that the team you put together in place will be able to execute on the idea and grow the company faster than anybody else that's trying to do the same thing. So like yeah, let's just showcase some of the team and expert consultants. They're all, or we've put together all either VC investors, experienced entrepreneurs, or MBAs that come together and work with me on helping out the startups we work with. Another key aspect of the deck is the market sizing. So here it's important to showcase more of the key elements that that show how big of an opportunity this is for both your company and for the investors that are backing you. So so you want to put in, you don't want to just say like we're targeting anybody that uses an iPhone or an Android. You want to be more specific, but big enough to capture the attention of investors. Basically, like our case where we're connecting, or basically serving the 550,000 new business owners and entrepreneurs each year, or that launch a new business each month, connecting them with over 750,000 investors that have made friends and family or angel investments. So, and other companies, you might do like the size of a specific industry and break it down into the types of users that, like, maybe within a virtual reality industry, you want to target users that are also in the gaming industry and showcase what your market size and potential opportunity is there. And also within the rest of the deck, you're showing why you can expand this market even further and grow the opportunity larger than what's taken place to date. You want to showcase your competitive landscape and differentiate yourself from the competition. So a lot of times, this can be two ways. One aspect, you can sort of compare yourself to existing companies, like a social media company. You could compare yourself to Facebook, Twitter, Instagram, and show what features, what community aspects you have that differentiate yourself from the competition. But also, like I mentioned, sometimes your competition isn't necessarily a company. It's using, like, for instance, I'm competing with advisors that take equity in the startups they work with and, go on a one-by-one basis, versus ours is a more of a consulting process and a group of experienced professionals that come in and work on anything from a one-off project to longer-term consulting projects. So yeah, it's key to show both the competition with other companies as well as with an alternative way of doing things, and how you differentiate yourself from them. Traction can come in terms of companies you've worked with, revenue, users, any aspect that's really you want to use to showcase basically how far you've come and give an idea of where you can take this from here. And along that line, you want to give a roadmap to the investors of what you've built to date, what you're looking to do, sort of like the next. Usually here you can say, we're raising $200,000 now. You want to put down milestones of what that $200,000 will help you achieve, and where where the next fundraise will come in and what that can take you along the way. The benefit of doing several raises is that you can basically, if you can break it down into key milestones, you can say, you know, at each, or you can raise enough now, not have to give up, the full equity amount in the company you would if you did a much larger raise, and just come back at that second point, once you've hit milestone one, have more of the boxes checked off on the traction, and be able to say, maybe we were a $2 million company in the first round. Now that we've hit milestone one, when we do our second raise, we're a $4 million company, and basically break it down into actionable growth items you can show to investors, and increase the value of your company, decrease the amount you have to give up in each round. And the last part I like to include in every deck is the financials. Sometimes it can be based on, if it's a revenue generating company already, it's based on previous results and projecting from there. Other times it's based on a user or customer based method. If we get to 200,000 users, what does that mean in terms of revenue? What does that mean in terms of cost behind it? Being able to showcase that. Also building in some comparables from other companies in the space that that you can use to showcase that, maybe not like on the marketing spend, how much, if you invest $100,000 into marketing, how many downloads will that turn into, and sort of price out, give a pricing and revenue model based off of the competition in the space. And you really want to showcase how much investment you need, where it will get you in terms of the roadmap you showed to the investors on the previous slide, and what you're offering on these deal terms. So sometimes, at an early stage, it might be convertible note or a safe, into then from there, typically a preferred equity round, and valuing the company based off of the financials you're showing, the growth trajectory. At an early stage, usually investors are looking for basically a company that can exit 10 to 20 times the value that they're investing in. As the company gets later stage, there's less risk. The valuation multiple is going to decrease from there, because you've already de-risked it, shown you have stable revenues, and you're already worth a lot more than you are at this stage. And you want to show them, you want to really paint a clear picture of that you're building something strong, where there's this problem needed in the market. You have the solution. You have the team behind it that's better than the competition. You've shown there's something really there that people want to see. Customers, partners, other investors that have come in, and basically, that with their capital, it'll accelerate the growth even further and take it to that next level. So yeah, this is, those are the main parts we focus on as we're building our investment decks, and happy to answer any questions, open it up for discussion, and looking forward to working with all of you.
All right, cool, Jason. That was an awesome intro to what a lot of these people can look at, and I wish some of them were in here. I mean, Doug's kind of more on our side of it, and Dennis is as well. So we're not going to get any of the well, anyways. But I know one of the questions that a lot of people have been asking are like, they'll say stuff like, I've been reaching out to people on LinkedIn and investors on LinkedIn, and none of them will respond to me. And why won't they respond to me? And how can I get them to invest in my company?
Yeah. Yeah. So I mean, the easiest. Well, I mean, there's two types of the warmer introductions that helps you get in front of investors. One is if you're connected with somebody that they're already connected with, they're more likely to take an introduction. Say, a lot of it can even come from a founder. Like if you know one of their portfolio companies and basically get introduced by a founder they've already invested in, or somebody, an investor they've gone into a deal with in the past that can send an introduction along. That helps a lot in terms of making that warm introduction. Another like warmer lead is if you can go and say, you're not just a random person I'm reaching out to on LinkedIn. It's I want to connect with you because I saw on Crunchbase or AngelList that you've invested in another biotech startup in the diabetes space or whatever your company is. Showing you've done some research around them before reaching out sort of adds another layer to that outreach and helps you get a response quicker than a cold email or LinkedIn outreach.
I think that's right. Trying to do your back end research to figure out who you can talk to. But I think that takes a lot of time, and a lot of founders that come in really early, they just don't. A lot of people just don't know really where to look. So I'm glad you mentioned AngelList. That's one place you can go, or Crunchbase, to kind of find out what these people are investing in, and you're really just kind of digging through. Actually, Doug, are you still there? Doug?
Yeah, I'm here.
Oh, awesome. I know that you've worked a little more on the later end stage of some of these raises. But then we obviously haven't had too much of a discussion. But do you have anything to note on like for really, really early stage companies and reaching out to investors? It's hard to put you on the spot, by the way.
Yeah, I mean, I guess for a really early stage, where you're looking for for an investor to give you their money. Yeah, I mean, this deck hits the point. I mean, what problem are you trying to solve? I mean, you gotta have a convincing pitch on that. If there is a problem that needs to be solved, then the only next piece is just convincing the VCs that you've got a plan to go solve it.
Yeah.
Yeah, and I mean, oh, sorry, it was someone. Yeah, someone gonna ask another or say something there.
No, I think it was background noise. Fire away.
Oh, okay. Yeah, so I was just gonna say, another key, and again, it's somewhat more challenging to find. I mean, obviously, it's hard enough to find an investor, but also the right investor that can come in and sort of help at an early stage as well, make some introductions to either potential clients, partners, or other investors in the space. But if you, the best or most likely investor to come in at an early stage is somebody that's experienced this problem themselves and really understands understands the industry and market problem you're solving, and sort of sees why the solution you put together is better than anything else out there. Yeah, so sometimes it's ideally it's somebody, an angel or early stage early stage fund that'll come in with sort of more of the background knowledge, and you really emphasize all the key points they're looking for. Other times it's just somebody that maybe they'll they'll know, or they'll, yeah, get convinced by the story you tell. Like I mentioned, a lot of times, they're investing in just the team. They see, what you've done in this startup in the past, that you have some experts on your team, either on your team or board of advisors, and might not 100% know like the ins and outs of the technology you built, but just betting on the horse and that you guys are the right people to execute on this.
You also mentioned the crowdfunding platforms like Seed Invest. Now, a lot of those require, $2,500 to put all your materials on it, and then there's also like a monthly fee. Would you? I'm just kind of curious, like, when's the right time to invest that amount of money into one of these crowdfunding pages? I mean, would you want to do it right off the bat? Would you want to wait until a little while? Would you want to wait until you have an investor? Would you want to wait until, I mean, I guess what would you, from scratch, I'm starting from scratch. When would you say is the kind of generally the biggest hit point when I should start investing cash into one of those crowdfunding startup platforms?
Right. Yeah, so there's a bunch of different models they use. Some, some do have more, or yeah, some have fees right away and like monthly. Other ones are more brokerage sites and have basically take care of a lot of it up front and just charge a success fee on the back end. But as far as when to crowdfund, on that side, it helps, or the larger email, email list or social media following you have, the easier it is to raise. Like if you can show, basically, if you can, on a lot of these sites, if you can go out, once you're on the crowdfunding site, push it out to all of your own channels, raise some capital there, and then have like the sites incentivized. They can show, this is like the hottest deal of the week. It's raised whatever $20,000 in the first 2 days it launched, or whatever the numbers are. They generally push ones more often to their emails and newsletters for the full platform as a whole that have shown some level of success reaching out to their own network. But yeah, I mean, it's great. Like, it's not a fit for every company. I mean, there's the larger ones that are doing regular angel rounds or VC rounds, can be a fit, just expanding the reach and the pool of investors you're going after. But the smaller crowdfunding rounds, those are the like more retail crowdfunding. It's great for consumer facing products. It's great for impact opportunities that sort of also get impact investors as well as financial looking investors to both go after. Basically has multiple opportunities, and also, I mean, and a reason it's good on the consumer side is when you have some capital, say you've raised a small angel or friends and family round, decide to go out and do this crowdfunding, you're basically doing marketing. Like, the money you're spending is going towards marketing to your end customers as well as people that are going to come back and invest in your business. So you sort of get that 2-in-1 approach if it's a consumer facing business.
So one last thing, and then I'll stop talking so much but you mentioned, just because you brought up impact investors, and that's kind of a newer concept that I was just wondering if you could make the distinction between your impact investor and your traditional, ROI investor.
Right. Yeah. So impact investors, generally have, a mission they're involved with, and it's sort of a reason behind their funding as well. So some, like, for instance, there's funds or investors that want to do sustainable investments in like green energy, other ones that can be might have a tie to like a particular, like, diabetes or cancer treatments, and make that the focus of their investments and portfolio. It's not a donation. They're still investing in companies that have a potential for return and financial success for them. But one of their main aspects of like what they're looking for involves some sort of impact on the community or the world, or a particular issue that they're really passionate about.
Oh, awesome. So those are the questions I have. Doug or Dennis, you guys want to jump in and ask anything? Remember, a lot of this is going to be for the new entrepreneurs that come through. So if you any issues that didn't get hit on, I'd love for you guys to bring them up if you want.
All right, man. Yeah, and so I'll be open. If you have questions or comments, like, you can go through the either on our Trello board we have on the Found Something group, or you guys can email me directly. Happy to answer any questions and help out, and get to know you guys better as you grow your companies.
Okay, awesome. So we're gonna put a link. We recorded this. We'll put a link for this on that Trello card, and then I'll let everybody know to go watch it. Like I said, there's a couple people who are looking forward to it. So that was awesome. All right, cool. Thanks, Jason.
Cool. Yeah. Thanks. Thanks for joining.
Yeah, man. All right. That's all.